Hi everyone, my name is Michael Frazis. Today we're going to go through some of our portfolio positions and obviously discuss the fairly severe tech sell-off that's been happening over the last few months. I'll go through kind of our thoughts on how things, kind of the macro positioning, that's kind of less relevant. I'll go through some of our core positions and also discuss where the best opportunities are, because in many cases, valuations have swung all the way back down to COVID lows. Returns were, the opportunity set was exceptional then. Sentiment by many readings has swung below that, certainly in our sector. And again, that makes for pretty interesting opportunities, but it's also a time we have to be very careful, because if you trade around at these kinds of levels, you can very quickly, the difference between a sharp loss and extraordinary gains largely depends on steadiness and what you do at times like this. And I'll give you some pretty interesting examples of that and talk about our own experiences during similar sell-offs. So to give a bit of an update, there's been a huge sell-off in growth. I mean, life science has been selling off more or less since February, and parts of the growth space have as well. But things really picked up in mid-November when the Fed kind of announced that they were going to shift into a much kind of tighter regime on the back of pretty high inflation numbers. The first phase of this was a rotation. And I say rotation because it kind of happened under the surface. So a lot of people that trade stocks, kind of long short funds, when they make huge positioning shifts, effectively the buys and sells cancel out at the index level, but you get these huge shifts under the surface. These happen all the time. Often usually it's other sectors and you just kind of watch them as an observer. This time it was most definitely in our sector, and there was a huge swing away from technology and within the technology space towards the handful of large caps. And those large caps have changed. 20 years ago there were technology stocks that were seeing kind of how like crypto is now. Those big question marks over them. Now they're kind of like the most defensive businesses in the world. They're really the new utilities. So when you think about NASDAQ and tech, there's a huge disparity between the fast growing, probably highest returning opportunities in the small and mid cap space, and then the larger companies, which are excellent, fantastic, almost like utilities. Something like Google, effectively every business, pays a tax to them to be shown high on search. So where we are is over 40% of the NASDAQ is down more than 50%. That's a pretty extreme move. Many stocks, including some of the highest flyers, have fallen a lot more than that. And it's been pretty, out of all the sectors, the internet's probably done the worst. So anything with like an internet flavor has generally sold off to COVID lows or below, or close to anyway. Largely, this was all triggered by macro. So I think that's why the shift was so big and why people got put offside, was because, November reporting season was actually really strong for almost all these companies. And it was on the back of tough COVID comps. So the November reporting season effectively was the quarter to September 30. September 30, 2020 versus 2021, you're already deep into COVID. So the year-on-year numbers were already tough. So for these companies then to report so outstandingly well, basically led to a rally and then a huge macro unwind as inflation fears kind of escalated and triggered this mass sell-off. One of the things that was more interesting was this institutional shift. So institutions swung from very overweight technology to the most underweight they've been in about 12 or 13 years. That's interesting. I mean, you don't really need to see the data to know that, but prime brokers do have that data. You can see it in the market movements. Generally, returns for technology were exceptional after that. So in 2008, huge shift out of technology. Everybody was scared it was .com bust times two, or the second run of that. The NASDAQ tech stocks actually bottomed, months before the rest of the market in December. Over the next 10 years, you could basically rank any institutional manager's performance by their allocation to technology. The more they had in technology, the better they did. So the huge institutional shift from back then was very predictive of like strong future returns, because obviously the companies themselves did exceptionally well over that period. And everything we're seeing in our companies, this hasn't been a change in fundamentals. This has been a huge macro unwinding, but we expect something similar. As these companies, as time flows and quarters go by and these companies continue to perform, institutions will have to pile back in, and it could be a process that happens over many years. It's very rare to see, the best companies in the world be so underweight. In more recent weeks, this has started into a broader market sell-off. I'm not sure what to think of that, other than I'd say that, like kind of large cap companies like Procter & Gamble growing at 3-4% a year, they're now trading at higher after-tax multiples than many fast-growing tech companies, including some of the ones that we own. So if you think about what's going to happen in the future, the odds of a Procter & Gamble type company outperforming a company doubling in size every year, extremely low. But now everything has started selling off. The other thing is we've been tracking a lot of sentiment indicators, and they've swung from very bullish to very bearish. And the limits to which these kind of were reached were very indicative lows in March 2020, in December 2018, 2015 and 2016, which barely anyone remembers, even 2013, 2012, when Apple had enormous sell-offs and then went on to be, the best performing stock. Huge drawdowns when the market was down, 10 to 20%, combined with the best performing stock by, market cap added. And we expect this time to be pretty similar. Another thing that was interesting was now quants are very short. So as markets fall, there's a lot of people like option market makers generally have to sell a lot. And then all the momentum quants just flip from long to short. And that is kind of what also helps the recovery, because as those things eventually flip the other way, then you get that mass buying in reverse of selling. All that stuff generally kind of washes out, but it's very interesting to know where you are at that point. So at this point, everybody is very short. And finally, I think the main point is there's a huge transfer of wealth going on. So this started as like an institutional panic. It extended into a retail panic, apparently. It's kind of harder to get retail flows. And basically, amazing companies are changing hands right now. And the returns from those companies over the next few years will go to the people that hold the shares. And the people that panic and sell after this extraordinary drawdown, and also obviously it's the panic and selling that's causing the drawdown, they're going to get really sharp short-term losses. So these things are never pleasant. They're always kind of horrible. There's huge different disparity in outcomes. In many ways, the Fed was way too easy last year when everything was going great. And now they're going full the other way and being extremely tight, even as things like retail indicators and so on roll over. That's kind of volatility. If anything, the central bank should be trying to dampen, but that's where we are now. The reality is these huge swings are going to create huge transfers of wealth from the people that end up with the shares, that end up owning these amazing companies, and the people that frankly will realize really sharp short-term losses. And a good equivalent of that was in COVID. Now, COVID was different. March 2020 was much shorter, sharper, hit everything. There wasn't like really much rotation. Everything just dropped, 35 to 55%. A similarity between that and us actually was that our stuff sold off long before and bottomed long before. So we were up 30, 40% for the year when indices were still down 20%. But if you saw us at the lows, we had two stocks that dropped 75% almost at the same time. We're probably the worst. It's hard to think. I'd be surprised if we weren't the worst fund to be in at that time. And only a few months later, one of the best funds. And by the end of the year, one of the very best funds in the world to be in. And this has similar flavors. The best companies are being sold down the most. They're probably over-owned. They're definitely at the top of their valuation bands, but there's nothing to suggest the fundamentals aren't still there. And, unfortunately, people are going to panic and sell, and they're going to lose all the upside. They're going to realize short-term losses. So our strategy is based around being on the other side of that, on capturing the long-term performance and potential of these companies. The way that you do that is by holding these shares. There's times when there's lots of bearish people that are being wheeled out now, like Jeremy Grantham. They call a crash basically every year. Occasionally they're right. Occasionally they're right 2 years in a row. But really the true value creation comes from people that own, the best companies. And so the reason we stay invested is because we want to capture that. And we will basically guarantee to capture the uplift of these companies and the value creation of these companies simply by keeping it real simple and staying invested. So one of the indicators was this AAII bull versus bear, lowest signal in 10 years, apparently. That again is pretty indicative of market lows. There's another one, another commentator put together something on tech, again below March 2020. We all know what happened then. We've seen in the fintech space in Australia, everyone will be familiar with Afterpay going from whatever it was down to like $9-10, like a huge 75-80% draw. It's been similar draws in fintech companies overseas with no real slowdown. These all reported exceptionally only a few months ago, and you can still track the data and it's still looking pretty strong. So it really has been a swing, and there will be a snapback. These sentiment readings won't stay down here forever. They will change, and there'll be pretty significant re-rating upwards when they do. Another measure is NASDAQ new 52-week lows. Now this chart, I actually got this chart off Twitter, but I should probably credit to someone. This is about a week old, I think. So this would be much higher now. And you can see with these big spikes, if you could go back to 2018 and buy, or March 2020, you would have done exceptionally well. Other measures include like equity put call ratios. So everyone's mass buying puts. Generally, that dampens volatility when it happens because the market makers are on the other side. And the other thing I'll just talk about like this macro thing. So we've always gone to a tightening cycle. Now, this is not new. There's been multiple periods of reduced of quantitative tightening. So you can see on this chart, there's a taper tantrum in 2015 and 16. Quantitative easing stopped. It then went down in 2018. There's also extended rate rising period where rates were risen a number of times between 2015 and 2019. Now, all those shifts in Fed policy, they're generally all accompanied by pretty sharp immediate sell-offs on the news. Then that repricing was absorbed by the market. And you can see that many of the market's best years were actually during those tightening periods. So I think 2017 was, for us, that was when we were long short, so it wasn't great for us, but it was that period of one of the best years in terms of risk reward for a lot of companies. And, even 2018, which was a really awful year, was followed by 2019, which was pretty good for most strategies. So there have been multiple periods where rising rate environments where stocks rise. If anything, to me, this was not, on the surface, it's all about this. And that's what the commentary is about. But it doesn't fit the data because, rates are still much lower than they were when these things were valued much higher. Valuation multiples have come down relative to where rates were at 3%, and we're still at 1.8% on the 10-year. What really seems to have happened is that big positioning unwind from institutions where things went from massively overweight to massively underweight. And that simultaneously caused a huge shift in markets and also created an immense opportunity. And actually, when things look dangerous, most dangerous with respect to that, they're usually safest. So this is some data from BAML. So you can see that generally tech was pretty well owned. So this is the chart on the left over the last kind of 10, 12 years. But it swung from that to being the lowest allocation from their fund managers that they tracked since December 2008, which is actually when tech bottomed and then rallied exceptionally hard, leaving almost every significant number of institutions way offside because it rallied basically almost till now on a relative basis. And we know where investors have gone. Investors basically flowed into late cyclicals, banks, energy, and materials. Some of that we think will do pretty well. We don't have positions, but energy looks pretty good. There's been much slower supply response to higher energy prices, which is bad for consumers, but good for the handful of people that don't care about ESG and continue to pump oil. But really, this is no time to be in late cyclicals, and truly expect, though obviously there's no guarantees and no crystal balls, but truly expect companies that are 3, 4, 5 times the size in a few years to dramatically outperform cyclicals from here. It was interesting to see Shopify had a 20% intraday swing. So last night was an interesting day because there was a 5% intraday move. There's times when that happens in bear markets. There's also times when that marks reversals. So in 2018, I remember 2011, there was a day like that. S&P dropped 5%, ended flat. That was a low and things just ripped after that. In March, there was a similar day. But then you could also go back to various bear markets where that's happened. In general, to me, that's a sign that there was a huge washout. Basically, what's been happening here is as prices have fallen, it's triggered more selling. Firstly, by quants, the trade momentum, but secondly, by institutions that just can't handle drawdowns bigger than 20, 30%. And at each successive lower price creates more selling. And these dynamics can be triggered in any market at any time for any reason. Obviously, rates and the Fed was the trigger this time. And the fact that everybody was so overweight made the swing much more severe. But the good thing about those kinds of dynamics is they end. When they end, things rapidly snap back. Once you put in that low and there's no lower price to trigger more selling, you get the flip side where people who sold are immediately offside and then in a pickle as to what they're going to do next. Fortunately, if you're long-term and just sit through these things, those kind of moves wash out. Though it's pretty clear that anyone would say that we're probably in the middle of a washout now. But there are reasons to think that we're getting towards the end, not least those sentiment indicators, also price action. So I'll go through a few stocks now. So that was plenty of our chat about macro. So C's obviously long been our largest position. It went from being a company that nobody knew to a company that it seems like every fund seems to have owned. If one mistake we kind of made was probably not realizing how these companies that we bought years ago, when literally be the only people that would mention Carvana, the same with Afterpay 6 years ago, even in Australia, to becoming a very widely owned stock. That is now unwound. The valuation is now unwound on an EV sales basis anyway. I put the long-term chart here just to remind you why we do actually hold these things, even when they're not at trough multiples. So in 2018, you could have held this thing at 10 times sales and you would have done so, you would have been one of the best performing stocks, even after an extraordinary drawdown. Now it's not 10 times sales, it's 5 times sales. And the company is absolutely dominant, all around the world. They raised money pretty high up, pretty close to the top. So they've got $11 billion of cash. They've got about $70, $80 billion EV/market cap. Their gaming business makes $3 billion a year. So Activision Blizzard just got bought out at 15 times. So that alone is worth about $45 billion, just using a recent multiple. Not that the market in the midst of a washout and a panic and a rout will pay, but a real company with a real balance sheet that will actually own the company, what they will pay. And if you do that, then the rest of the business, which is like one of the top e-commerce businesses on the planet, trades for something like, half-time sales. This is a drawdown chart. So you can see this is the most severe drawdown. So all the gains are going to accrue to C are going to go to people that end up with the shares at the end of this drawdown. And curiously, the difficulty is, I guess what's been challenging for us is we'll hold these things while they're performing well. And, C has done exceptionally well over the last few months. I'll give some examples of that. Actually, I was asked to talk more about earnings. So you can buy this on, say, 25 times EBITDA next year. And that assumes a dramatic slowdown in growth to like 36%. It's actually growing at 120% plus as of October, with gross profit growing 150. Wipe out all that growth and knock it down to 20 or 30%. And you're looking at a 24 times EBITDA company, or 39 times after tax. And this is a company that is entering new continents. So they just entered India and became the third most downloaded e-commerce app. They just beat Amazon, which has been there for years. They beat them in months. They just entered Europe through France, Portugal, and Poland, and Spain. And they've been pretty successful in South America as well. So a company that's going through a crazy investment cycle. And I say crazy, but that's exactly what we want to see. Like the companies that invest and grow are the ones that will perform the best. You can buy that on earnings or a P multiple at the moment, which gives you an indication of, firstly, how far things have swung, but secondly, the scale of the opportunity and why it's so compelling at the moment. Here's some data. So the bottom right chart shows C's app Shopee in India, and you can see that it's that maroon line. It's just kind of overtaken Amazon India. And you can see kind of on the left charts where Shopee is dramatically beating Lazada, which is Alibaba's play, in a number of their core Southeast Asia markets. Obviously, C comes from Southeast Asia. And this is kind of their results. So the revenue is up 121%, gross profit up 147%. It's surprising to see a company drop to valuation troughs after a result like that. So it's one thing for things to go, it's one thing in COVID for everything to go down when nobody had any idea what was going to happen to spending. And there were those weeks where everybody just cut spending to zero, basically. It's one thing to see things go to like valuation troughs in those environments. There's another to see things go to valuation troughs when they're performing exceptionally well. And that is an opportunity. And that also bodes very well for us in the future. There's just a few surveys there. People seem to really love it. And you can see their performance in South America. What else is worth mentioning? There is some concern at the moment. There are two things that kind of caused the sell-off, to the extent that, I don't think anything caused this sell-off. I think it was triggered by rate rises and then a massive unwind. But to the extent there were fundamental concerns, it was a slowdown in gaming. Downloads seem to have stabilized, but this is, again, a business that's annualizing, just under $3 billion of EBITDA a year on a company that's, traded down to a $70 billion EV. So that's pretty good value by any means, even without any growth. Yeah, another one that was interesting was Carvana. So Carvana's done the full swing, full roundabout, not quite COVID lows, but definitely like to lows. So again, like C, C's up. C would be up. We bought around 45, 46, and it's trading at, say, 100, probably up 3-4 times from purchase after a 60% drawdown. Carvana is down, not quite 60%, but close. It was up 15% last night. It's still up 4 times from our initial purchase. So we still have extreme conviction in this strategy. We can weather, when these stocks are right and they hit their numbers and they grow, as all of our companies are, you can have 50, 60% drawdowns and still be up over 2 or 3 years. Now, I know that's kind of a bitter pill for people who invested, over the last year, kind of the top of that drawdown. For better or worse, it seems like most of my friends and family joined the fund, after watching it for 5-6 years early last year. So very aware of that's like not exactly a pleasant thing to experience when you go through those drawdowns. And I know that doesn't mean anything. You bought something, it's 4 times up, but if an investor is down, they're down, and that's how they feel. But it's really important to know that this strategy does work, and we can have these huge swings, and everything can go wrong from a macro position. We can have, worse sentiment in 10 years. We can have biggest swing from institutions since the GFC and still be up several times on core positions after only like 2 or 3 years. It's important to know that, because that's kind of what gives us so much conviction, why we stick to the strategy and why we do what we do, why we don't sell these things as well. Anyway, again, to bring back, Carvana's been killing it, 2 consecutive quarters of profit. There are kind of slight headwinds in terms of it's been a very good car market. Who knows what will happen there? But even if you assume growth slows all the way down to 25%, it's trading at like a 15 times PE after-tax earnings multiple, in 3 years. And we're already kind of partway through that 3 years. We could say 11 times EBITDA. So you can value these things. And this is why we bought it. We bought it at a $5 billion market cap with margins going up, knowing that it would maintain or expecting it to maintain 100% plus growth. It's still today, it did that. It went from from a few billion revenue to kind of like 15, higher now, I think. It did that and margins increased, and it's still growing super fast. And so margins will increase on a much higher revenue base, and you will be able to value these on earnings and EBITDA. Now, there's plenty of people kind of like doing a victory dance because they thought it was a short at 36 and it went all the way to kind of 360. Now it's at 150. So because it's done that drawdown, they feel like they've got it right. Obviously, it's pretty clear where you want to be. This is that drawdown chart. So 2020 was a bit of a breakout year for us. Like we raised no money, and it was a very small fund before that. And March was pretty horrible for us. There was a 73% drawdown in our two largest positions back when we had very concentrated positions. Ended up being our best year. That was the price. To get that result in Carvana, the price was to catch that drawdown. There is no way that anybody would be able to trade those, as far as I'm aware anyway. The simple thing is the long-term investor gets the gains. You just had to sit through those drawdowns. We're obviously in one now. It's sharp. It's a similar kind of magnitude. In many of internet stocks, it's actually much worse. But since the fundamentals are so strong, there's no reason to think that returns in the future won't be strong as well. This is Mercado Libre. Now, Mercado Libre, relative to C, they're a very good payments business. I'll just highlight a few things on this chart. So GMV in countries like Argentina is still 100% plus, and e-commerce monetization is still very low in these countries. Roughly kind of half where it would be in somewhere like Australia, probably a third to a quarter of where it is in China. It's kind of hard to measure e-commerce penetration because there's so many different ways of doing it. But it's clearly a very underbanked market with a huge amount of growth ahead. And again, to come back to profits, you can actually trade this thing on, it grew at 100% plus for many years, and it's trading on 60 times EBITDA 2022, so that's this year, and 39 times EBITDA next year. Again, it's going through a heavy investment phase. It's wrong to value a company growing this fast with this enormous opportunity on its current earnings. You can actually do that now because the sell-off has been so severe. There's serious valuation support for these companies now. You don't need to be a growth investor. Of course, the people that actually made real money out of these companies, and even now we're probably up 2.5 times on it, again, after a huge drawdown, still up 2.5 times. You actually had to buy it when it wasn't making money and when it was growing and going through that heavy investment phase. Twitter's another example. And the reason I want to talk about Twitter is there's this idea that this sell-off's been caused by a washout of non-profitable tech companies. It's not quite true because the profitable ones have been hit as well. Really, it's other than kind of the big 4, 5, 6, it's really the whole space. So Twitter is down to 4 times sales and 16 times EBITDA and 36 times PE, and expected to grow earnings at something like 400%, EBITDA at 120%, top line at 40%. And they're 2022 numbers. That's this year. So you can value this as it's valued. What was Procter & Gamble valued at? I think it was a PE of 28 or 30. Roughly what a stable company that's growing at 2, 3, 4% a year. You could almost get company growing at earnings at triple digits for similar PE. And that's kind of the scale of the opportunity. That's why we're so confident in the future. And that's also, it's just interesting. It's interesting to see how far things have swung. All trends are looking pretty good for Twitter as well. Camplify just reported, funnily enough, and it's probably why this sell-off has probably come a surprise to some Australian investors, is largely Australia's been unscathed. I'm not sure precisely why. I think it's just a different market. Actually, I'd say the reason why is, and actually fits with the idea that this has been a massive position unwinding, is the kind of strategy that we do. There are funds in the US that do it. It's quite common. There's pods. So there's funds that will have tens or hundreds of billions of dollars who will very quickly give traders long short books that are quite large, in the hundreds of millions or more. Our strategy actually became, we were doing this long before, but it became flavor of the month, and a ton of these kind of fast money traders got into it. In Australia, there's very, very few funds that do anything approaching what we do. So I guess that's why there's been less of a swing. And that fits in with the idea there's been a huge positional unwind. Positional unwinds are much better than fundamental unwinds. Because if people are just selling it because everybody's selling it and prices are going down and they're overweight and they're being stopped out and they can't lose more than 10% on any stock or 20%, and the risk manager comes out and forces them to sell, if those kinds of dynamics generally quickly rebound and they create huge opportunities for people willing to buy or simply just hold on the other side. And again, like the value for all these companies, for things like Twitter, is going to go to the people that hold the shares. The people that sell them after a 60% drawdown are going to lose a lot of money very quickly. And the people that hold them long-term will get all the gains that will come from companies like this that are just throwing off cash at the moment. Camplify just reported, growing exceptionally fast. I'll zoom forward. They actually increased their take rate. So at IPO, it was 24%. It's now over 31%. It's now 31%. Cash flow positive. This is one of our favorite picks in Australia. It has been for quite some time. It's been pretty good for us. So Camplify next year is trading on 9 times EBITDA, triple-digit revenue growth, and obviously much higher EBITDA growth. Square's been fascinating to watch. We sold out of both Afterpay and Square after the acquisition. Thought we're being smart, but to be honest, with the entire internet sector down 50 to 80%, didn't really make a difference. But this is something we'll probably look to re-enter because, on an EV gross profit basis, it's looking exceptionally cheap. The valuation has clearly digested that enormous acquisition. So from memory, it was 39 billion and the current, EV is 54 billion for both Square and Afterpay. We don't own this yet, but this is something we're probably going to look to add in the next week or so. If you're interested in how we're trading. I got asked what we're selling. So we sold Moderna. That was a big one. Obviously, we think we're kind of post-peak vaccines. I think there's extraordinary pushback from 3rd, 4th, 5th doses. And all those earnings are behind. And in biotech, it's very hard to, once earnings start declining, share prices do very poorly because they're very forward-looking. Now, they've got one of the best R&D pipelines in biotech. So I'm not saying it's an amazing short, and I really hope they do well. I think you now need to value Moderna on their research pipeline and then really kind of discount the cash flows. So you need to assume that, vaccine uptake rapidly runs down over the next 1 to 2 years, and then value their research pipeline. So we'll get back in, but not yet. At the moment, with so many internet companies down so much, there's huge opportunities elsewhere. Oh, this is Square. Actually, one thing I'll show on this chart, which podcast people can't see, is there's a very interesting price action last night where everything just legged it down. As I mentioned, there are 20% swing in things like Shopify. To me, I've seen those at market bottoms multiple times, though apparently if you go back, 20, 30 years, sometimes things continue selling off. But clearly, there's no magic in technical analysis. There's no magic in looking at price charts. All it means is everything sold off to a really low level and then for whatever reason, snap back. And hopefully that's the end of this price-driven selling, where lower prices beget more and more selling. Once that low is in, all those dynamics reverse. So one thing we're kind of looking for is once these companies put in a low, there's a good chance they rally for a very extended period of time. And we really hope we're at that low now, as no doubt I'm sure everybody else does as well. I was asked about Upstart. Here's the price chart. So we bought it this is one of those things we've done a full round trip on. So we bought it after an amazing result. This was the result, 250% organic growth, income from operations 134%, contribution profit up 184. Yeah, these are huge, exceptional growth numbers. You can trade it. It's like 30 times EBITDA this year, or 39 times PE. So you can value these things on after-tax earnings, which is kind of what I'm saying. It hasn't been profit-driven. This isn't that big washout of non-profitable companies that so many people who've missed the tech trend over the last 2 decades seem to be calling for. Instead, it's a positional thing. So, it became the hottest stock for a while. We actually sold a little bit at 400, got our entry price down to 120, but that hasn't helped us in recent weeks because obviously it's gone all the way to 91. And I think at the low last night, I was up. It was 10 to 15% below that. But again, numbers will win. If they continue posting results like this, and the early data suggests that they are winning in the markets where they compete, they should do exceptional well. And basically, they do personal loans, and they're just getting into car loans, which is significantly bigger. And the end game for them is mortgages. So they can quickly, using AI rather than credit scores, approve people for mortgages. And they just do the AI stuff. They just do the approval. There's a bank on the other side providing the credit. So they don't take the credit risk. That's why their financials are simple, and that's why they make so much money. But there's no doubt this has been like a hairy experience, for a company that triples and then almost triples and then drops all the way from $400 to 91. We've effectively been in it the whole way. The bulk of our position we've actually bought in the last 2 months. It was a small position initially, but it just gives you a sign of how things have traded. And it's another indication of what's been happening. It really seems like a mass rush into these stocks and a mass reversal out. And again, the people who hold them, hold this, all the benefit, all the profits this company makes, all the value they create, it's going to accrue to whoever ends up with the shares at the end of this washout. And we will certainly not be selling. Open Door's super topical as well, because this has been particularly hard hit. Interest rates aren't good for real estate. And this is one of those proper venture capital style investments. This is an investment where enormous market growing super fast. It's like, I think it's a $6 billion market cap now. They could do 25 billion plus of revenue. They don't need much of a margin on that. They have got up to 10% gross margin. But you don't need much of a margin on that to be one of the cheapest businesses in the tech space. But you just have to accept they're playing a long-term game, and they've created an extraordinary amount of value. Even at the lows, they've created a $6 billion company in a sector that didn't exist before them. And we expect them to go on to bigger and greater things, especially now the main competitor is out of the game. It's kind of like Carvana in the sense it's an enormous market with very few other people. I thought I'd also cover Open Door. So this is using profit forecasts. So again, it's loss making. We expect it to be so in the future, but it's only kind of 2 to 3 years away from generating pretty serious profits. Their strategy is actually, they charge 5% at the moment to transact a home, increasingly getting people on both sides of the transaction. Their aim is actually bring that 5% down as low as possible. So they're just the most attractive and vastly better than using a real estate agent. And the way they'll do that is by offering ancillary services. So that's kind of the game for them, much like Carvana actually. So Carvana underprices cars by about $1,000. And a lot of what they make is in the ancillary revenues. So in this case, title, potentially mortgage origination fees, things like that. And you can see these enormous upgrades as the stock has been really punished from a price of 35 all the way down to 9. It's a huge swing, a lot like Carvana and Afterpay in the last mass washout in 2020. But it's not because the business has slowed down by any means. So questions, is the fund currently buying anything? Yeah, we've been, last night we did small ads across the portfolio. As I mentioned, we sold Moderna. We did sell some biotechs. Unfortunately, biotech has just been a bear market since Feb 2021. So we've had 2 severe bear markets in our 2 sectors. It's been pretty painful, but still, very extremely optimistic about how those industries will evolve over the next few years. So Open Door we've added a little bit to. Roblox we added a little bit to last night. Upstart we've been buying. What are the other major ads? Obviously, Twitter's a major new position. They're the things that we've kind of been adding to. Any progress on getting the fund listed on the ASX? It is in process. It is in process. We're just trying to assess demand for retail product. We've got quite a long list of people that have said they'll invest in it. We're just unsure. We just want to make sure there's minimum scale when we launch it. Question on C versus Melee in Latin America. C's playing a longer game in e-commerce. C's got their gaming app, which has allowed them to rapidly and cheaply acquire users everywhere. But Mercado Libre seems to be more inbuilt to the payments infrastructure and is further along the way to profitability in the continent as well. So far, both companies seem to be growing exceptionally well, much faster than the market, and the market itself seems to have a long way to go. So I don't think it's an either or there, especially from these valuations in both of them. Roblox, I think, is pretty compelling here. Obviously, we track things like time and kind of user stats. It still look pretty good for Roblox. It's addictive. This is one of a kind company. There's, once you're in that ecosystem as a developer or a player, you're going to stay there. It's super exciting to see. While it's painful, we originally bought at these levels and then effectively not quite doubled, but almost doubled, and then has come all the way back down, almost all in the last few weeks. It's very painful to see that, obviously, but that doesn't suggest anything. The fact that interest rates have caused a big sell-off for Roblox says nothing about their future. I don't think there's a single person that buys or sells or interacts with Roblox games in any way, is in any way dependent on interest rates. And that's kind of across our portfolio. Then these companies, I think these companies are so robust because they're not cyclical in the way most companies are. But in many ways, that probably, if I think about what's happened over the last few months, in many ways, that probably gave people false confidence. And that led to institutions being mass overweight these companies, feeling that, in a downturn, they're going to be fine. Now, the reality is in a downturn, they will be completely fine. They're sitting on enormous amounts of cash. Even the ones that are losing money are generally cash flow break even because they pay employees in stock. But because they're so robust, they're just massive overweight, and a scare, which in this case, the scare happens to be the Fed, could have been something else. It was the Fed, caused a mass rush to the exits. And that's what's caused this huge sell-off. But even I've kind of made it my business to speak to like fund managers I know around the world over the last few weeks. There's a lot of people who are having to adjust. A lot of people have to sell. A lot of people have to degross. A lot of people changing positions. But generally, it's all to do with market price and portfolios construction rather than and kind of trying to sell as fast as they can to try and minimize downside risk, knowing full well that the companies themselves are fine and they might miss the bottom 10% of a drawdown. They're just banking that they'll be able to get back in. But as you saw last night, there's 15, 20% intraday swings in $100 billion companies at the lows. So my philosophy has always been you buy on the way down and you hold through those ultra high, sharp, volatile periods, which always happen around the lows. We get these huge up and down swings. And that's because the rallies and recoveries can happen in 36 hours. Or in the difference between selling at the low, at the open last night and the close could be 15, 20%. I truly believe even now, even when like there's been a mass institutional selling of technology and growth stocks, that the long-term approach will vastly outperform people that try to catch these moves. Instos shying away from companies that aren't making profits. It's part of it, but I think it's more, like I said, I think there's a group of stocks that just became like almost a basket, and then a bunch of people own them, and then they've kind of sold those. Some of them were profitable, some of them were like Twitter, some of them were unprofitable, some of them were like Carvana, which massively increasing profitability, just became profitable. To me, it was less about that. It was more just like a macro-driven shift, which I think is actually quite positive. What would trigger a rally in markets? Well, price-driven selling will just burn out at some point. I don't know where that is. I'm hoping it was last night with that huge intraday reversal. I'd say there was a shock on the Fed from the Fed. Interest rates have gone up 1%. That's 4 rate hikes just got priced in. That was always like when you look at previous tightening cycles of the last 10 years and longer, often when on the announcement, initial repricing, that was when the sell-off happened. And then actually when the rate rises came through, markets rallied. Markets always getting ahead of these things. So funnily enough, as things calm down, as what is feared happens, that could trigger reversal. I think also when these companies report, that will also potentially trigger reversal and people finally get a look. Like it's been so long since reporting season. The last reporting season, we're about to get another one. Everyone get a look under the hood and you can see these companies that just dropped 50, 60, 70% are still doing completely fine. And we can track the data and we can see that they are doing completely fine. What's the other thing? M&A sometimes puts a floor under these things as well. So you saw that with Microsoft. So Activision Blizzard absolutely tanked. Microsoft was willing to pay a massive premium. It's effectively fair value. They know that business better than anyone. They get the cash flows. It's their capital on the line. That kind of shows you where the real buyers that can write 10, 20, $30 billion checks, where they think true value is, and it's way above where markets are now. I was asked about Futu. So we still own this, but this was probably this was one of the more painful stocks in the portfolio. It's swung all the way from 34 times P down to 13 times. It's one of those companies that's been part of the Chinese sell-off. Interestingly, it looks like that has largely played out. Chinese tech stocks have actually been outperforming throughout this period. So it'd be interesting if, there was this huge swing out of China by all the US kind of growth funds into growth stocks. They obviously pushed software multiples up to extremes. Right as internet was selling off, which was, we got, I guess, 3 things that hit us: tech growth sell-off, China, biotech bear market. Yeah, it'd be interesting now that those things rally just as everything else is under so much pressure, which if you're a student of markets, you'll know happens all the time. And if you want to see some of the results, paying clients 179% year on year, plus 179% year on year, gross profit plus 91.6, gap income 53% year on year. So still strong growth numbers. And these are a company with a P of like 13 times this year. Ukraine. Look, I think like things like that are completely relevant to our companies. Like wars often provide shocks. Funnily enough, equities generally do well in the aftermath of them just because there's weird stimulus. Obviously, it's not pleasant. Hopefully that situation doesn't deteriorate, but I don't see any impact on any of our companies. I could see risk sentiment getting another washout, but the more that risk sentiment gets washed out, if we push to a new sentiment low, that's really going to set us up extremely well for the next few years. So as a quick summary, sentiment is now below COVID lows. We've gone from being full bull accelerator to, absolute panic. I think the returns, I don't know if it'll happen as fast as it did last time, but I do think returns in the aftermath of these big sentiment washouts will be the same. Even if things deteriorate further, I still think they'll bounce back and you'll get this huge rush back into these amazing companies at the back end of it. It's been the largest institutional swing from tech since 2008. So remember that was December 2008 was that low in that chart. That was when tech bottomed. The market bottomed in March 2009. Tech rallied onwards. And then institutions were put offside for a decade after that. Funnily enough, haven't met many institutions, but through the journey of this fund, I have met some institutions. Most of them kind of seem to have cut their teeth in the first tech crash, where some institutions were way overweight technology. And the handful of both fund managers and allocators that dodged that crash never believed in technology ever since. To them, technology is the way most people look at crypto now. Something that internet was just something that was going to go away. It was always overvalued. They then missed Google, Amazon, search, mobile, software, all basically the value creating measures. And they only had a very, very small number of funds that survived that bear market. And then they got the entire market to themselves. Go to Silicon Valley and try and find a fund that's been operating for more than 20 years, very hard. Actually, there's another parallel. Think about Australia. There's surprisingly few commodity funds for a country that's focused on commodities. The reason is there was commodity washouts periodically that put them out of business. Anyway, the point is that to bring it back to technology, that technology low caused a bottom, and then also as institutions came back into the market, led to extended multi-year, decade-plus rally of that performance. The other key point is this hasn't been driven by fundamentals. It's been a huge macro positioning unwind. It's been triggered by the Fed. I guess it could have been triggered by anything. We will probably in the future be much more cautious when we see institutions so bullish our positions, because when we buy these things, they're not. For example, we're buying positions now when everybody is kind of washing out of them. I think some people think we chase momentum. We don't. We buy things when they're getting smashed up. Certainly our initial purchases. And, we expect that to do extremely well, buying on the other side of that trade. On the earnings point, after-tax earnings multiples, I gave you some examples. They're often on par or even below where stable, non-growing companies are. That's an exceptional opportunity because their earnings will grow at exceptional rates. So we don't need multiples to go back up. I actually don't want them to go back up. I just want companies to track their fundamentals, which for us, given they're all growing at 50 to 100% plus, would lead to very sufficient returns from here, even after our drawdown and even without any change in sentiment. So if sentiment and multiples stay this low, we can still generate very strong returns just because the companies themselves are doing so well. The other point is, just going back to that chart that I showed, in the past, the Fed has caused a few kind of scares. There's the taper tantrum, 2015, 2016, started raising rates. There was a multi-year period where they were raising rates. It's a multi-year period where they turned the taps off quantitative easing and then started tightening. All these things have been, we've experienced all these things. Not quite as, we've never, the swing that we haven't had is from ultra easy to that tight. That was the shock. But that's behind us now. There's nothing to particularly fear in a rate rising environment, particularly after multiples and sentiment has washed out so low. And in many cases, we're at COVID lows in terms of multiples. That was an opportunity. Like there's so many, so talking about 2020, I always talked about how hard we got hit. And then we did pretty well afterwards. This is just one of those moments, and it's kind of sad. I know people will be selling shares in a panic and just saying, I'm out. I know institutions have had to do that this entire way. It's not necessarily their choice. It'll be risk managers. It'll be these pods that can't lose more than a certain percentage in a month. There'll be allocators that say now's we're going to allocate away from technology. These people are stewards of hundreds of billions of dollars. Their end clients will then likely miss out on the value created by the tech sector over the next 5 to 10 years. These things, the shifts in wealth in these moments are enormous, and it's really important to be on the right side of it. And we will be on the right side of it. And if this continues, we'll still be on the right side of it. because we'll just stay invested in these companies, and we don't need sentiment. We don't need valuation multiples to go up for us to generate returns. They can actually continue going down. And as long as our companies are growing faster than that, we'll still perform pretty well. Yes, it's been a pretty tough period for our strategy. It's hard to think of a more perfect storm than institutions going all in on our sector and then going all out. But that doesn't mean, but it's extremely encouraging that the company themselves are still doing very well. It's also encouraging for us to look back on our long-term positions and see they're still up several-fold, even after kind of everything in the macro environment outside went wrong. So yeah, I mean, I guess the message is it's important to stay invested in these times. If you can allocate, you've got to take advantage of these opportunities when you see them. Because again, you can get on the right side of these shifts and do extremely well. If there's any more thoughts on Pinterest, I should just answer 2 more questions. Thoughts on Pinterest? We have owned it, but we ultimately exited it because we thought there were better opportunities. User growth is declining. They're making $1 billion a year of EBITDA. They're trading pretty cheap, but given that you can buy companies with rapidly growing users and rapidly growing revenue per user and also profitability, then you may as well, Pinterest is probably not the best option here. Another interesting comparison with Pinterest is it's about the same EV sales as and EBITDA as Google. So if you're going to go for an advertising business, you're better off going Google. And I think coming out of this, now is the wrong time, but when I reflect on what we can do better, there's quite a few things, obviously. One of them is we will start allocating to some of those large companies just because they're so much more robust at times like this and give you much more optionality to buy into companies that do get smashed. So companies like Google, they're still trading way cheaper than the rest of the market. They make really good opportunities. We explicitly excluded them from our fund. But if we do make a change at the end of it, we'll probably include some of those. But now's not the time. Now's the time where actually our stuff that's down, such extraordinary at valuation lows are very likely to be the best performers. They may have been some of the worst of the last few months, but they're very likely to be the best performers both in the short, medium, and long term. So that's not a change we're making right now. I might wrap up there. Thanks everyone for listening in. Good luck and make sure you're on the right side of these shifts. And we'll do this again soon. Thank you.